Welcome to today's webcast. KPMG has been approved by NASBA to deliver CPE-worthy training. In order to receive CPE credit, you must attend for the entire session and participate in interactivity checks. Interactivity checks will appear on top of your media player and may or may not be verbally addressed by presenters. Participation is tracked, and failure to participate will result in denial of CPE credits. If you have any technical issues during the webcast, please submit a question through the Questions and Answers panel, and our producers will respond to you directly. Please submit all content-related questions through the Questions and Answers panel.
Hello and welcome to the TMT breakout session for the Global Financial Reporting and Valuation Conference. I'm Tim Lashua, a partner with our accounting advisory practice and leader of our technology, media, and telecom industry. I'd like to welcome you. I hope you had a great session so far on Monday and Tuesday. We're very excited today to really unpack an issue that I think is transforming all industries, and that is Web3 and the metaverse. But it is also having a profound impact on our industry, the technology, media, and telecom industry. And so today we're going to really unpack what that means today and what that's going to mean in the future, and actions that you can be taking today to really position your companies for success in this new world. So with that, I'd like to welcome Tony Brzezinski, who's going to be leading and moderating the session today, and he'll introduce our agenda and further speakers. So Tony?
Thank you, Tim, and thank you to everyone in the audience for joining what I expect is going to be an exciting topic and interesting discussion. My name is Tony Brzezinski, and like Tim, I'm a partner in KPMG's accounting advisory group, and I work primarily in the telecommunications and technology industry. Our agenda is going to start with an overall discussion with Alex Elias around the metaverse, Web3, and the infrastructure enabling the metaverse. Then Alex and I will be joined by Scott Muir and Tony Toos for a panel discussion around some specific accounting and tax matters relevant to those that are or are expecting to be participating in the metaverse. So I want to introduce our panelists, beginning with, and you already know Tim and myself, so I'll start with Alex Elias, who's going to do a presentation around the metaverse. Alex is a manager in our innovation lab, which is part of our Ignition Center. Alex specializes in leading technology trends and disruption research. Scott Muir is a partner in our Department of Professional Practice. Scott is our National Office Technology Leader and Topic Team Leader for software costs as well as digital asset accounting matters. Tony Toos is a principal in our tax group. Tony's an expert in the taxation of financial products, digital assets, and complex capital markets transactions. And so I'm going to start, or we're all going to start with Alex Elias. Alex, everywhere we turn, we hear more and more about the metaverse and Web3. I'm hopeful that you can help us in the audience to sort of demystify and describe what is the metaverse and the infrastructure that it depends on, and what sorts of business opportunities is it creating? So with that, Alex, I'll turn it over to you to begin.
All right. Thank you so much, Tony. Really appreciate being here today to get to speak with all of you. Today, as has been discussed, we're going to talk about the metaverse. And what we're going to do today, we're going to define it, give you some frameworks to help understand it, and we're also going to look into some opportunities and threats that companies are wrestling with. Lastly, we're going to explore what's being done right now and what businesses should be thinking about. So with that, let's dive in. Let's start with definitions. So the metaverse is the next iteration of the internet, a persistent set of experiences and places that will fully integrate with your physical life. Now, there are a number of different definitions out there, but three common components are included in most definitions. And we see that as virtual worlds, which are persistent, always-on 3D-like experiences, avatars that represent real people and real interactions, and lastly, digital assets like digital goods and currency. Now, these three things are really helpful to keep in mind when trying to decide whether something is truly the metaverse or not. Let's take a look more closely at where we are today. So even though things are really still just getting started, we're already seeing some signs of traction. Over 100 million experiences have been created in these virtual worlds, and where people are spending a lot of time in them, over 40 billion hours just in 2021. Across the top three platforms, there are already 450 million monthly active users. On Roblox alone, there are 55 million daily active users. And people are spending real money, with 80 billion being spent on virtual goods and video games in 2021, and that number is expected to grow all the way up to $190 billion by 2025. As with most new technologies, adoption is mostly being driven by the youngest generations, in this case Gen Z, who will soon be the largest consumer cohort. Our surveys have found that Gen Z have used a metaverse platform within about half of them have used the metaverse platform within the last few months, and 35% of them have made a purchase in that platform. As we often say, our best experiences anywhere become our expectations everywhere. And as Gen Z becomes the largest consumer cohort, their metaverse experiences will drive what they demand from everything else. Now, this is a common misconception that the metaverse always is VR and that you have to have the big headset and the goggles on to be in the metaverse. The metaverse is not always the same thing. You don't necessarily need the headset to access the metaverse. Today, most metaverse activity is happening on tablets, gaming consoles, and smartphones. And we're going to see, as it continues to develop, that more and more of these experiences are being designed to be used across these different entry points, and even more so with AR interfaces that better seamlessly blend digital and physical environments together. So as Tim and Tony talked about, I'm also going to spend a little bit of time talking about Web3, blockchain, and crypto. These are words I'm sure you all have heard, and hearing all these metaverse terms, it can get very confusing very fast. Web3 also refers to a new evolution of digital spaces, and it can be thought of as being developed really in parallel and overlapping with the metaverse, but it's really not quite the same thing. So with all these terms, it can get confusing very fast. So we're going to break it down into three Web3 categories that we describe as primitives. So tokens are finite assets that that means not copyable, that exist in perpetuity to the owner. These assets can take the form of money. They can be governance or have voting rights like stock. They can even take on the characteristics of alternative investments like real estate or art. Blockchains are the system on which it runs. So the blockchain records all the transactions and is decentralized, meaning that to record a transaction, rather than getting a central authority like a bank to verify or hold on to the record is transparent and transactions are verified digitally through complex cryptography. Lastly, we have smart contracts. Using tokens and blockchains, you can build automated agreements that will execute when certain conditions are met. This allows many decentralized applications to be built that operate with far greater efficiency to their previous Web 2 counterparts. With just these three primitives, you can build whole new worlds, and by using them together, things can get really, really interesting. So, as I mentioned, they overlap and somewhat intersect. There is only one metaverse, much as there's only one internet, but there are many metaverse worlds within. The many different worlds reflects that each world has its own infrastructure and user base. I mentioned that Web3 and the metaverse are being developed in parallel and in overlapping ways. Well, there are a number of worlds that combine the two and a number of them that don't. As good consultants, we love a good 2x2, so let's explore how they intersect. In off-chain worlds, transactions are made with traditional currency and digital assets are locked onto a single platform. In on-chain worlds, transactions are made with cryptocurrency. Digital assets are NFT or non-fungible token based, meaning that they can move between the platforms. This slide shows how the infrastructure and user base of these different metaverse worlds can be very different. And additionally, here are some that you may have heard of and how they shake out. Understanding the differences will be important for building a metaverse strategy because each segment has its own considerations. Now, TMT companies are at the forefront of building this metaverse, and I'm sure we've all been hearing a lot about this. Mentions of metaverse-related terms are skyrocketing as companies rush to build and focus on this next evolution. But why are all these companies flocking to invest in the metaverse? A lot of its impacts are likely years away. Well, a number of these companies grew up with the internet or had to fight off disruption from the internet over the last several decades, and they recognize this threat when a new area opens up. It has the potential to threaten many traditional TMT revenue streams, for example, advertising. The metaverse enables brands to go direct to consumer and really create unique experiences that drive deeper engagement. How might more traditional advertising falter in the face of this more immersive opportunity? In social identity, we've seen a number of social media companies spend an awful lot of money attempting to build and control pieces of the metaverse. That's because they recognize that a new iteration of the internet will allow consumers to curate a different, more personalized identity that would leave earlier web profiles in the dust. Subscription content with more immersive and personalized storytelling. How can traditional content compete? Hardware. As always with new waves of technology, the hardware through which we access it changes and new winners emerge. No one wants to be the Kodak of this group, and companies are acting accordingly. Characters. In the metaverse, you aren't just watching your favorite characters, you are them. Companies with strong IP in one arena may not be suited to the next if their characters, for instance, don't transcend their initial environment, or worse, if their legal department won't allow them to. And lastly, search. Many of the major tech players have search businesses, and how might that change as individuals move to new platforms and searches become more complex than basic information as this all moves to the blockchain? While many of these companies are feeling the sting of these threats, there's also ample opportunity in this developing space. There's the ability to create new use cases and applications to engage users, from shopping to virtual content search to gaming to education and more. New emerging technology is improving metaverse offerings, and integrating mixed reality, AI and machine learning are driving personalization, and brain-computer interfaces are offering the potential of greater accessibility and ease of use. Companies can also target generational niches with experiences that fit with their desired ways to engage in this new space. Beyond the type of offering or use case, companies can differentiate their brand within the metaverse by offering greater personalization, unique IP, strong community building, and improved connectivity. Organizations can also look to mergers and acquisitions in this space as a way to grow and differentiate, and also seeing the way that it's going exponential as an indicator of future growth potential. Lastly, a number of prominent ESG concerns can be mitigated through the metaverse, including inequality, new access, environmental concerns, and more. Now, I don't want you to get the impression that the picture is entirely rosy. There are several challenges that companies will need to solve with regards to the metaverse. For starters, it's possible that across those ESG concerns, for many of these social and ethical implications, the metaverse as it's currently constructed could potentially do more harm than good, given the risks of misinformation, bias in AI algorithms, energy usage, and more. There are also a number of issues surrounding new technologies, from cyber sickness that sometimes accompanies VR to privacy and mental health issues, just to name a few. The technology itself will need to improve drastically to bring more people in simultaneously to these virtual worlds and have them interact without issues of latency, bad resolution, etc. Lastly, there are many regulatory issues, and I know we're going to talk some more about this part on the panel, that must be ironed out as this new space develops. How do we see TMT companies developing in the metaverse today? So as we dive further into this, see how folks are building this, just from a very high level, we want to give the sense each individual company may land somewhere on this continuum. But from a very high level, most telecom companies are focused on building the infrastructure side of the metaverse. More media companies are focused on user needs, and tech companies fall somewhere in the middle. What are these companies doing as they take action in this space? Well, after looking at more than 140 TMT companies and their actions over the past 4+ years, we see that they're making moves across 7 key areas. You have destinations, assets, entry points, networking, compute, payments, and security. The 3 on top here are more consumer facing, the bottom 4 are more infrastructure focused. To give you a sense of how developed each of these categories are, we've assembled some M&A statistics for you. Despite the challenging economic environment, the space has still seen significant growth in the past year, up 9% year over year, even if you take out the major outlier that was the Microsoft Activision deal. If you include that, it's up more than 1,000%. Without that deal, the top categories getting investment are compute, destinations, and entry points, indicating that the money is well spread between both infrastructure and consumer-focused layers. One interesting piece to note, there's been fairly limited deals and advances in the security layer, which presents a unique opportunities to companies that have capabilities there. There we go. We've covered the what. What about the how? So in looking at those actions of those 140 plus companies, we see they're developing those 7 categories in 5 different ways with varying levels of maturity. We've seen that some of the companies are talking about the metaverse primarily as PR or just to be seen as innovative, while others are deeper in the space, hiring, building, buying, and partnering to make this a reality. I'm sure a number of you have seen various news articles or releases saying, oh yes, we too are in the metaverse now, without really any broader plan as to how they're going to get that done. That fits more over on the market side of things, while we see others going full throttle, building these spaces, building assets, and really creating very unique opportunities. Because there's so much to be done in the metaverse, there are so many different paths you can take. I mean, even I've outlined 7 categories, 5 different ways to accomplish them. Within those 7 categories, there are a myriad places to get started and ways to get involved. What we found is that it's really easy to get lost. And so you can very easily go just start doing different initiatives and really find yourself in a place where all these initiatives don't connect and they just wither on the vine. While serendipity and experimentation play an important role in innovation, being intentional at the outset as to what your desired role is in the ecosystem can help keep you on a path. Your initial desired archetype may not be the one best suited for your organization as the space evolves and where you ultimately want to go, but having that focus and revisiting that focus regularly will really help you understand all of the moves you make and where that's going to leave you. There are a number of different archetypes that exist, and companies are already targeting specific ones. There are a number of archetypes that exist around experiences and the different types of experiences you can create, platforms and places to build those experiences, hardware and devices that you can build those experiences on, being a portal to the metaverse and existing across some of those spaces, different places within the infrastructure, and even for folks like ourselves, there's a place to play on the auxiliary side of things. Though some companies have set a path and are often running, on the whole, most companies are just getting started. Most companies we surveyed indicated that they believe that the metaverse will likely be a part of their future business. In fact, greater than 94% of folks felt like the metaverse and Web3 technologies will be important, but very few of them have actually aligned on common definitions, let alone set a distinct direction. As I've tried to lay out here, getting very clear on what your definitions are, getting very clear on what your desired outcomes are, is really what will help you move forward and actually land where you're looking to go. So how could an organization get started? In our research, we've identified key considerations across some initial maturity phases. These are by no means exhaustive, nor are they by any means the only things you would ever need to do as this space evolves. These are changing constantly. But essentially, across some initial phases, you can start off, and really this first phase is about exploration, and it's really getting a better understanding of where your organization is today. What's your organization's domain? Where do you occupy? What space do you occupy? What are your strengths? What do you do well? And thinking about the archetypes and where do you think you can or should play? The second phase is centered around experimentation, creating and leveraging new assets, new partnerships, new brands. And this also involves taking a much broader look outside the walls of your organization, potentially beyond your traditional partnerships, into new spaces with new folks who are emerging around this, new winners. The third phase that we focus on is scaling. So refining your growth directive, your business model and governance as you move away from a pilot into a launch, as you think about what is it going to take to really make money and succeed in this space. So really, with so much excitement and energy moving into this area, the next few years are going to be very interesting, to say the least. This is a space to keep an eye on. Thank you all so much for listening. Back to you, Tony, for our panel.
Thank you, Alex. I mean, that is astonishing. The pace of change is really, really exciting. Also presents a lot of challenges and opportunities. So part of what we heard from you, Alex, and sort of in my own words, is that Web3 is part of the infrastructure that enables the metaverse. Cryptocurrencies and NFTs are instruments that facilitate commerce within the metaverse. I think that inherently is going to present for business leaders, for people that operate in finance and accounting, a number of different questions and issues. And I want to bring Scott and Tony Tooths into this conversation now. And Scott and Tony, can you give us a sense for the accounting and tax considerations that arise for companies that are transacting in cryptocurrencies and NFTs and participating in the metaverse broadly?
Yeah, sure. Scott, I'm happy to start off on the tax side, Scott. Yeah, just because it's all from a tax perspective, it's all the same things you would normally think about, just with some wrinkles on the asset side. So timing, when do I have income? When do I have expense? Character, is it ordinary? Is it capital? And source, which is a particularly hard one in this area, is it foreign source, U.S. source, and even once I'm in the U.S., which state source might I have income? And so those things can be challenging, but it's all the same type of things that we're thinking about. We're in the tax world. Scott?
Yeah, I mean, I think the way I look at the most common accounting questions that sort of link into the idea of the metaverse revolve around NFTs, crypto asset, cryptocurrency accounting, and how do you deal with the development and content development that goes along with the metaverse. I mean, for example, right? I mean, one of the most common misconceptions about NFTs is that I have sold an NFT, basically treating the NFT as if it's a product. To me, I think about this a little bit like in the spirit of the holiday season. An NFT is a little bit like that shiny wrapping paper you get, right? The wrapping paper is not the gift. The gift is actually what's underneath the wrapping paper. NFTs are very similar in that regard. The NFT is not the good or service that's being sold. You actually are going to look through to the goods and services, for example, often licenses, sometimes other event rights or unspecified rights to future NFT drops, services. These are the things that you really need to be accounting for, whether you are the purchaser or the seller of the NFT. And like I said, oftentimes there's sort of a inappropriate sort of distraction looking over at the NFT and giving yourself a different answer than you would get if you were to actually look through it. Now, yes. I'm sure nobody is unaware about cryptocurrencies. I'll kick it back to you in a second, Tony. Cryptocurrencies, just remember that most cryptocurrencies are intangible assets. So you're going to see people in the metaverse receiving cryptocurrencies as payment which is non-cash consideration, brings up 606 revenue recognition concerns. And then oftentimes you have companies holding cryptocurrency if they intend to transact in the metaverse, either because they received it from a customer or because they had to buy it in order to then go buy that, piece of virtual real estate they coveted for their expansion into metaverse. And it's important to remember what crypto assets are under US GAAP accounting, which is intangible assets, and the model that applies to those while you hold them. Tony, you want to jump in?
Yeah, I like the wrapping paper analogy for NFTs because it's the same on the tax side. Unfortunately, for tax wonks, is that people use this term to mean an entire field of things, and as Scott was saying, an NFT can be anything. And so, same thing as for accounting as for tax. We need to look underneath the hood and say, well, what does the NFT really represent? And it's that thing that's under there that's going to dictate how we're going to tax it. So obviously, if the NFT is a concert ticket, we're going to tax it like a concert ticket. But if we look under there and the NFT is the deed to a building, well, we're going to treat that as real estate. So we really need to know what we're dealing with in order to get to the right accounting and tax answers.
No, absolutely. And just to dovetail off that, the same is true for GAAP, the way you said it, Tony, right? It's the accounting depends on what the underlying is, not the NFT, right? Oftentimes you will see in an NFT, the most common form of NFTs is a licensed intellectual property. However, oftentimes there's a misconception that the piece of digital art or the video, that you get ownership of that. Well, when you go through to the underlying T&Cs that are, put onto the blockchain, you see that you actually don't have a right to use it, right? So the seller's revenue recognition, for example, if I sell you an NFT and I mistakenly treat the NFT as a product or mistakenly treat it as a sale of IP, I'm going to get very different accounting than I should rightfully get if the NFT is actually a license to intellectual property. The one other area that I thought that probably would be a good thing for this little question you asked, Tony, was you got to think about your development, right? As companies move into the metaverse, a couple things occur to me. First, you have a lot of companies moving into the metaverse space that are not high-tech native companies. Things like consumer beverage companies or clothing manufacturers, that they are not necessarily in their historically chosen lane when they're now getting into things like developing a metaverse environment and the things that come along with that, minting NFTs, for example. So it's important to remember that as you are expanding into the metaverse, remember what guidance applies. A metaverse itself, of course, is a software environment. Make sure you're considering the internal use software guidance in ASC 35040 and the website development cost guidance in ASC 35050. We have seen some metaverse companies now also get into the external use software space as they try to create desktop or on-device software that actually goes on your machine to allow you to better access the metaverse. Now, when you do that, that software that they're going to put on device goes through the external use software guidance, not the internal use software guidance, which those two things differ very much. The last thing I'll highlight is then you have to think about the content, right? If you're bringing up experiences in the metaverse, for example, you may be creating media content like video content that has its own gap. ASC 926, for example, covers film or video costs. So just make sure you sort of understand and think through all the things that you are developing and creating for this metaverse, and make sure you've mapped that up to the gap that actually applies to those things that you are creating.
Yeah, that's a great point, Scott. And something that's not specific necessarily to the metaverse, but is a huge outcome of building out the metaverse. Tony, is there any specific tax considerations as it relates to the cost to develop software, websites, basically the metaverse?
Yeah, so the tax rules around your expenses and getting into this space, building out the space, these are all going to be our luckily, this is one area where we have some rules. We're going to talk about some other areas where we have no rules. But here, we can use the same old expensing and capitalization rules that we use anytime that we're working with digital assets or technology that we build software. So there are certain costs that we're going to be able to expense up front, and there's certain that we're going to capitalize and we're going to depreciate over a period of time or amortize over a period of time. So that piece we have getting more complicated is, when we're accepting crypto or paying crypto, we only really have one rule, which is we treat cryptocurrency as property. And in this respect, I will say we're a little behind here in our tax rules. When we were speaking about NFTs, the industry has advanced a little bit, and we know now that we need to look underneath, see what the NFT is, and each one might be taxed differently from the other. But the IRS got out ahead of us in 2014, and they issued a notice, which we're still bound by, which is treat all crypto as property. And it's good and bad. In the bad side, we treat all of these things exactly the same. When you really get into it, some of the cryptocurrencies are quite different from each other, and perhaps shouldn't all get the same treatment. But be that as it may, just treating them all as property, what that means for this client set is, if you accept crypto as payment, then every transaction becomes a little mini barter transaction. Someone's giving you property and you're giving them property or services, whatever your product is that you sell. And so you do have revenue recognition, that we are going to have income from a tax perspective when that happens. Valuation becomes a little bit of an issue because we're not using our central bank currency. We're not using a US dollar or euro or yuan. We're getting this property. And you would think that all cryptocurrency has a very strict value, but the truth is, the markets for cryptocurrency are not as efficient as they are for widely held publicly traded stock. So there are pricing discrepancies between exchanges, and so you really need to come up with a convention to get the valuation straight. So that's on the crypto side, and then on the NFT side, it can become even harder sometimes. We already said we look to the underlying to see how we should tax it. But as Scott was saying, we have this added complexity that there's often what we call nested contracts in the NFT. It might be a license or a royalty, but it might be other things. In the case of, for example, in tokenized real estate, there's many different contracts that are embedded in there. For tax purposes, what we need to do really is break them apart. And our first major issue is when you buy an NFT or take an NFT or drop an NFT to a customer, you have to bifurcate the cost basis between the nested contract and whatever else it is or may be. So we still have it creates some complexities. Luckily, our tax rules are catching up slowly but surely, and so we're getting there.
Well, I mean, Tony, you made an interesting point, and I think it's one that we shouldn't lose on our audience, which is, crypto asset isn't a single thing, right? The terms crypto asset and digital asset sometimes get thrown around a bit interchangeably. Sometimes those of us that are, really deep in the space use those terms to be digital asset a little more broadly than crypto asset. But you have ones that are different, right? Bitcoin, Ether, those types of crypto assets get accounted for like intangible assets and get treated in the GAAP accounting literature as, you exchange one for the other. It's just, a good for a good. There's no currency involved. But then you have other crypto assets that frequently find themselves in the payment space, things like stable coins like USDC or, the Binance coin that actually may not be accounted for as intangible assets. They're on the blockchain. They're sort of indistinguishable in that respect, but they actually meet the definition of a GAAP financial asset. And those run through entirely different accounting and function, much more akin to typical currency in that regard.
Right.
And maybe to pivot for just a second, and Tony, you had mentioned, that the tax rules surrounding some of these assets. Can I ask, have regulators and accounting standard setters addressed these issues? And if so, how? Where are they at?
Yeah, so I'll start on the tax side. Regulators around the world are actively working on this, but it's a slow process. So as I mentioned, the IRS in this country came out early, for better or worse, in 2014 and told us cryptocurrency is property. They never told us what kind of property it is. So that has meaningful implications as we work through the various tax situations. However, they continue to put out guidance, and so do other governments around the world. But the priority items really surround tax reporting and anti-money laundering. Most of the countries around the world have to solve that issue first before they get to the other issues. And so what you've seen in the United States at the end of 2021, when the Infrastructure Act passed, there's a couple of provisions in there. In fact, the first statutory provisions we have in the United States that even use the term digital asset, and those were all about tax reporting and anti-money laundering. And so starting next year, what we'll have in the United States is a rule that says when you transact in cryptocurrencies, or any digital asset for that matter, there will be 1099 reporting, and that's obviously aimed at closing what is a perceived tax gap in this country with respect to that. In the other one, which is purely an anti-money laundering rule, there's a long-standing rule in the United States that anytime a business accepts cash of more than $10,000 in a transaction, it has to be reported to the government. And that's of course why you don't see large cash transactions in this country any longer. And what they did was they decided that the term digital asset, which is a very broad term, that should be treated as cash for that purpose. And so businesses in this country are going to have to start reporting transactions of over $10,000. We're hoping the regulations that come out on that, and we won't see those till next year, but we're hoping that narrows the scope of that, because obviously that could be a lot of things. But this is happening around the world. The OECD issued their CARF notice, which is their crypto asset regulatory framework. The EU has their own version of that, and you're seeing other countries around the world, Australia, Brazil, Hong Kong come to mind, that have pretty advanced advanced is a relative term, but have already started down the road towards regulation. But you will find that they're all largely aimed at anti-money laundering and tax reporting. Scott?
Yeah, I mean, from the accounting perspective, the FASB has an ongoing project, but the project is relatively narrow. The project, if you recall, I talked a few minutes ago about how most crypto assets, the ones you think about, the Bitcoins and the Ether, are treated as indefinite-lived intangible assets, which means that they are recorded at their cost, less impairment, and can never be written up for changes in market value. That is fundamentally what the FASB is trying to change, and it's not much more than that. Their project will not touch things like, they're not going to create a special model for NFTs. They're not going to create anything that really tells you that a crypto asset is not an intangible and is therefore not non-cash consideration when you sell it or receive it for a good or service. So the accounting is still moving sort of, I would say, very slowly behind where the industry is evolving. The regulator, in this case, the accounting regulator being the SEC, has, of course, taken some of its own actions. For example, they spoke at the AICPA SEC conference this week and basically came up with their own model for how to deal with crypto asset lending transactions. Okay, this is something where GAAP does not really address the loaning of an intangible asset. So it doesn't meet the definition of a lease, and it's not really a sale, so what should you do with that? They're coming up with effectively their own rules that they don't necessarily link to an explicit GAAP standard. And of course, earlier this year, they issued rules around elevating transparency of crypto assets that you hold for others with Staff Accounting Bulletin 121, and that has produced a no shortage of endless fun from the perspective of application of that over the last 6 months or so.
But and one reminder for the audience, or maybe notification for the first time, is there is a Q&A portal at the bottom of the screen, I think is how it will show up for you, where you can submit questions to the panel as well. So feel free to do that. We'll keep our eye on it and try to address any questions that come through. And so far, staying on the topic of regulation for just a second, we've heard about accounting standard setters. We've heard about taxing authorities. Alex, I'm going to turn to you and ask, beyond tax and accounting, what other regulatory bodies are looking at the metaverse or digital assets? And, we've had just recently, we've had a fairly large, accounting scandal that's sort of in process right now. Who are the other bodies that are involved?
Well, for those who are aware and have spent some time looking into the FTX scandal, we just had a House panel in Congress. I believe it was, if not yesterday, it was sometime earlier this week, that hauled some of the crypto folks in to take a look at that. They're looking at more broad regulation to help decrease fraud, but it's very interesting as a space for on this topic because it often comes across the partisan divides. So it's not necessarily split up into sort of one group is for, one group is pro. You have people on either side of the aisle who are both pro and against, and really what they're trying to get a better sense of is, what is necessary to develop this further. You have some potential regulation being put out that would help solve more, for lack of a better term, traditional fraud like what we saw in the FTX scandal. And then you have others who are pushing for some more onerous regulations that may, hamper the overall growth. Like, for example, Elizabeth Warren's proposal would really do some major damage to the way this is done. It's pretty interesting because it starts to run into really an example of broader tech regulation. So there was another group called Tornado Cash, and their owner or the chief developer and founder was jailed because there were those who were using his blockchain for ill intent. And so it starts to once again bring up a lot of questions from a regulatory perspective of, what is the responsibility of a given set of tools to who is using it, which creates a whole other rabbit hole to dive down.
Well, okay. Thank you, Alex. I want to turn back to the accounting for just a second. So far, we've primarily been talking about the balance sheet and the recognition and measurement and how to look at some of the digital assets or the costs incurred. I want to talk about the income statement for just a second and ask, kind of more specifically, how companies should be treating the sale of some of these digital assets and how that differs between on the accounting side and the tax side.
Well, I think we'll start with the accounting, and then Tony can speak to how that sort of differs. But from an accounting construct, a crypto asset, and again, I keep trying to make sure I'm clear about which ones we're talking about. Remember, I said there's some that meet the definition of financial asset that would fall under Topic 860 for the transfer of a financial asset. But sticking more around the ones that you're more likely to see, for example, in a metaverse type scenario like Ether, right, which is the blockchain on which a lot of NFTs and things are developed. Those are non-financial assets, right? So you really get the same model as if I was going to sell you a different intangible asset. If I was to sell you my trade name, Tony, that's really the same model that would apply to me selling you my Bitcoin. Okay, so you're going to follow either Topic 606 if selling crypto assets is an ordinary activity of my company, or you're going to follow 61020 on the sale of non-financial assets to non-customers otherwise. And in all those cases, right, some of the complexities that arise are you are trading a non-financial asset for a non-financial asset. So Topic 606 and 61020 get into non-cash consideration. So what you're always going to end up having to do in these cases is I'm going to, assuming I transfer control of my crypto asset to you, Tony B, and you give me a crypto asset in return, I am going to recognize the fair value of the crypto asset you gave me as revenue and on the balance sheet, and I'm going to de-recognize the crypto asset at its carrying amount that I have. And it's in some ways it's relatively simple to think of it as no different than any other non-financial asset, but it also starts to create real complexity when you're doing things like staking crypto assets and getting paid for that service in crypto assets. There's a number of complexities that arise because of the way US GAAP currently treats all of these crypto assets as non-cash consideration, even when they are, paid as consideration for goods or services.
Yeah, and on the tax side, not so different. Obviously, if we have crypto on our balance sheet and we sell it for fiat, that's going to be a taxable transaction. We're going to have gain or loss. However, more likely than doing that, what would happen is you'd have a non-stable coin digital asset that you're going to exchange for a stable coin. Obviously, keep assets on chain, but that too is taxable for in the U.S. So either way, we're going to have gain or loss. The issue that we have is, normally when we take payment for goods or services, we're doing it in fiat. And then if I move my fiat around, there's no tax consequences that I had income on my sale, but then the use of fiat inside my system, inside my corporate, has no consequence. However, here, because it's property, it does. And so right off the bat, if I sell crypto, I have arguably a capital gain or loss. If we're operating in the corporate form in this country, getting a capital loss is not helpful, especially when a lot of the type of companies we're talking about here are ones that only or normally only generate ordinary income. And so we'll be left with a kind of a mismatch. So we need to get into one of three areas to get a better answer. One is it inventory to me in somehow, some shape? A few companies, the way that they use it, it could possibly fall into inventory, most not. The other way that it could fall in is if it's deemed supplies for tax. If we could get there, it would be ordinary as well. And in certain cases, that'll be true, especially among ETH, because you have to use ETH to pay gas fees when you transact on the Ethereum network. So there may be a not such a bad answer, but on other crypto, it's going to be harder. And then the last one is if it could be a good tax hedge. But I think what you will find when you start thinking about that is that it's very hard to meet that definition here. And so until the government gives us a better answer, which I would hope they do one day, we're stuck with this answer where it's just property and it could absolutely show us capital gain or loss, and it's on the loss side obviously that we're going to care. The other thing that I'll mention here is that if we're dealing with NFT, so most, by the way, I didn't say this before, I should have, most of our states that have given us guidance, and there's not a lot, but those ones that has told us that cryptocurrencies aren't subject to sales tax in most of these states. Also in Europe, we've got some rulings not subject to VAT, but the same is not true for NFTs. NFTs often are subject to sales tax and VAT. And again, as the wrapping paper analogy, I'm never going to forget that one now, goes, we look underneath, see what it is, and if that thing underneath is subject to sales tax or VAT in that jurisdiction, this will as well. And so we want to be mindful of that when we're selling these things too. We don't want to forget about the indirect tax as well as the direct tax.
It was funny that Scott used the example of me providing him or paying him with some digital asset or digital currency. I think I'd have to borrow some Robux from my 7-year-old in order to do that. So I don't know that I have any other. So, we've primarily been talking about a pretty specific set of digital assets. There's another type that I think is growing in prominence that, I wanted to kind of give the audience an understanding of. First of all, maybe starting with you, Alex, can you help to explain, what is DeFi, and then maybe turning to Scott and Tony around any specific accounting or tax considerations around DeFi?
Yeah, absolutely. I think DeFi is definitely an area that can get very confusing very fast. From the most basic understanding, it is decentralized finance. So if you think about the idea of a blockchain as a transparent ledger where each transaction is being recorded, the first round of what makes most sense to use that for would be to replace a centralized financial institution like a bank. What decentralized financial apps and institutions are trying to do is they layer on top of the blockchain various types of applications. It can be loans. You can have various trading applications on top of this that all operate based on smart contract without the intermediary. It can be a lot more efficient. It can move a lot faster. There are a host of issues that still need to be developed. I think, personal opinion on this, a lot of the crypto space is getting hammered primarily in the same way of the .com bubble bursting, of that there's a lot of scams out there. There's a lot of pets.com out there, and chickens are coming home to roost right now. but there are a lot of very interesting ideas that sit underneath this that can really develop. I've seen some experiments in DeFi around different types of loans, around mortgages, around asset-backed collateralized loans that can be very interesting. You've seen a number of these exchanges, so long as these exchanges are focused on being exchanges first and foremost and not offering 40% return in perpetuity, that's usually a good sign of a scam. That a number of these exchanges can do some pretty interesting things. But very curious to hear what we're hearing from some of our accounting and tax clients.
Yeah, I mean, I think from an accounting perspective, the issues all come from, I'm going to have to quickly walk through sort of an example transaction flow to then describe what the issues come through. Okay, the funny thing that is that Bitcoin is not a very operable blockchain. It doesn't enable smart contracts, and Ether, the native token of the Ethereum blockchain, is actually not an ERC20 or compatible token for operation on Ethereum-based DeFi protocols. So the first leg of a transaction we often hear about is, how do I get my Bitcoin or my Ether into a compatible token? I wrap it. And this has completely nothing to do with my wrapping paper analogy. We call it wrapping a token, taking a Bitcoin and getting a wrapped Bitcoin. That wrapped Bitcoin I could then use in these decentralized finance protocols like liquidity pools, where effectively, rather than depositing my tokens with a bank and earning interest, I'm going to deposit them into a smart contract, a non-entity, and earn a return on the transaction fees from other people that come and interact with that smart contract in order to access the tokens that I've locked up in the smart contract. And so if you think about what I just said there, that's a lot, and I'm trying to do it quickly, but I traded a Bitcoin for a wrapped Bitcoin. I then dropped a wrapped Bitcoin into a liquidity pool smart contract and got a liquidity pool token, almost a receipt, in return. Well, what's the accounting that goes from all that? Do I have revenue or gain generating transactions from those exchanges? Do I de-recognize the tokens I've deposited, even though I've deposited them potentially only with a custodian who can't use it, or with a smart contract? Or do I keep them recognized? And if I keep them recognized, have I simply borrowed the ones I received in return, which can trigger then derivative accounting? So there is a whole mess of issues that have not been resolved in practice about the accounting for these new and emerging DeFi protocols. I would simply say stay tuned, and hopefully that gave you a quick flavor of the myriad issues that are still coming up.
Hey, thanks for that. In similar in the tax world, we have very, very little guidance, if any, around DeFi type transactions. But of course, business goes on. This is a huge part of the industry. Once you decide to be in the crypto market, have crypto on balance sheet, those types of things, and then you need to work with it, you will necessarily work with DeFi protocols. And so from a tax perspective, similar to the accounting world, we have to come up with something for these. So when I'm wrapping, for example, as Scott was saying, when I wrap my Bitcoin, is that taxable? It becomes a right up threshold issue. When I exchange one token for another, is that taxable? The IRS guidance we have is kind of plain Jane. It absolutely says exchange of one token for another is taxable. But however, in this case, the industry has come to the consensus, and most tax practitioners have as well, that no, that's not taxable in that particular case, because typically, not always, but typically when I wrap a token, I can bring, and then they give me the wrap token in exchange, I can put the wrap token back and get my underlying token back. And so that's more like a custody arrangement, an ADR or something like that, which is not taxable. So we have that piece. The industry consensus is not taxable. Then I go out to the DeFi protocol. I want to engage in my transaction. And the problem is, again, we use DeFi to mean a whole lot of things, and they're not all the same. And if I go to, like, if I want to lend my crypto out to increase my yield, and so I go to maybe like a Compound or Aave or something like that, and I transfer in my token, they give me another token exchange. And again, in those type of protocols, I can always get my underlying token back. So there again, we say that's not taxable. as the rewards as we earn rewards, those are taken into income. They're treated as ordinary income when received, equal to the fair market value of the tokens we get as rewards. I will tell you there is some discrepancy in the market as to the exact timing of income depending on the exact protocol, but typically that is the answer. Ordinary income on the day received equal to the fair market value of the token received. But then you go to a different type of DeFi protocol, the one that Scott was just talking about. If I go to a liquidity pool, what I do is I take two tokens, a pair of tokens, and I transfer them in exchange for the liquidity pool token. But in that instance, what I will eventually get out of that liquidity pool, in addition to the rewards, I could get all of one token, all of the other, a different ratio of what I put in. So there, the tax rule is that is taxable in, taxable out. And of course, I do continue to pick up my reward tokens. So there is some nuance around how each of these things is taxed. And I think part of the problem we all share is the tax reporting, or any kind of reporting, out of DeFi protocols is not great, or non-existent in some cases. I could say the same about CeFi exchanges as well. So that has a long way to go. So it does make reporting and keeping track of things a little bit difficult, I would say. But at least even in the absence of regulatory rules, the industry has come to consensus around how we tax most of the major items and transactions in this space. So we do have a path forward.
That is interesting. Thank you very much. We are running out of time, but I did want to zoom out for just a second again and ask Alex in hopefully 2 minutes or less. Can you've mentioned all of the mentions of metaverse and related topics and public filings. I think you've mentioned a couple of the different worlds within the metaverse, including Roblox. What are some of the worlds that have the most momentum, activity, users that are in the metaverse?
So I would say at the moment, there are very few Web3 based metaverse worlds that have a lot of momentum. But on the Web2 side, as we mentioned, Roblox is a huge one. Minecraft is another. Fortnite is huge. Meta is doing its best with Horizon Worlds, and we'll see how that can develop. And the fact that it can span both enterprise, corporate side, and also consumers interesting. Engage is another really interesting platform that KPMG we've built Metaverse Worlds in for enterprise corporate use. On the Web3 side, though, they've been struggling recently. There is some interesting use cases around Sandbox. Decentraland's another one to keep an eye out for. And on sort of a slightly different perspective from the more traditional, here's a space build, you have something like Axie Infinity, which has really created a novel experience and gameplay that has really taken off in Southeast Asia. So just a couple of things to keep an eye out for. And, as these spaces start to, move beyond simply a place to go and game and really move into, they're just sort of places to exist and do everything that you do in the physical world, in the digital world, and have that interact with your physical environment.
Thank you very much. So I think with that, we are running out of time. I'm gonna close it out. I want to thank the panelists for all the time and insights. It's clear that we're all going to hear a lot more about these topics as we move forward. As Alex pointed out, and then I reinforced, the references to the metaverse and related topics is skyrocketing. It's just growing off the charts. And I would expect that trend is going to continue. And as each of you think about your involvement in the metaverse, Web3, with digital assets, there's obviously a lot to consider from an accounting and tax perspective. And beyond that, I think, especially in light of the FTX issue that's ongoing right now, I think we can expect more regulation more broadly. And so with that, I appreciate the panelists. Want to thank our host, Tim Lashua. Want to thank the audience for your time and attention, and want to wish everyone a good afternoon. Thank you very much.